So I've decided that I either have the hardest or the easiest job discussing a paper on limited attention at a ski conference where everybody's been out skiing all day at the last possible time. But either way, thanks to Jim and Abner for asking me to discuss. So Kelly did a nice job of presenting the paper. So I'll just real quickly summarize the results. And I think it's easiest to kind of see the main results looking at their figure 3. And the first point here is that the passage of time after the merger announcement contains information about the likelihood of completion. And you can see that in their estimated hazard rates, which peak at about week 15 to 20, depending on whether you're looking at the cash-financed or equity-financed mergers. And then if you look at variation in those hazard rates over time, that contains information that predicts stock returns. And you can see the pattern in stock returns that follows. And so they look at this strategy, they try to rule out risk-based explanations, and they're able to do that. They do a pretty good job of that, and they form portfolios, for example, based on high hazard rate deals compared to low hazard rate deals. They also find that the results are strongest in deals that are difficult to trade. So they conclude that because of limited attention, information about the completion probability that's contained in the passage of time after the merger announcement isn't fully incorporated into prices, and limits to arbitrage prevent other traders from trying to get rid of this mispricing. I like this setting for thinking about attention effects. I'm going to focus most of my comments really on thinking about sort of interpretation issues and trying to understand attention. So I like this setting for a couple of reasons. One, the focus on lack of news. So I think that's a little bit different than what we usually think of in terms of attention. And there I think you can think of it as similar to a couple of recent papers by Gao and Ma and Marin and Olivier that look at the information that can be gleaned by the lack of insider trading. So I think it's kind of along the same lines. The other thing that I think is unique here is a setting where we have an event where there's a very large attention-attracting event in the form of the merger announcement, followed by what they think of, or what they sort of talk about as the passage of time where there's no news. I don't think the paper fully takes advantage of that sort of setting, of that specific component of the event. They really focus more on the lack of news after the merger announcement, but I think it's the difference in attention from the merger announcement as we go further that can help us really learn something new that we aren't able to look at in some other settings. So I want to provide a little context on attention and what we know about that, and then I'll focus on a couple of areas. One is I think we need a little better explanation of the mechanism through which attention limits or attention constraints are working here, and I'll talk about that a little bit more. And then lastly, I think if we could condition on other types of information and separate the types of deals for which the passage of time will be a really important indicator of completion and information for investors from the types of deals where other types of information and other types of variables are important, we might be able to come up with more powerful tests. So I'm going to talk about a couple of things along those lines. So in terms of some context, I think it's useful to start with psychology, where it's well known that humans have limited attention. So Kahneman, for example, talks about the fact that humans have limited attention, limited cognitive resources, and the fact that because of this limited attention, you have to allocate your cognitive resources across tasks, and if you allocate resources to one task, that reduces the amount of attention you can spend on other tasks. So I think it's a very natural setting, and we can start to apply it more in other places. In terms of economics, I think it fits very naturally with the ideas of bounded rationality. And Gifford, for example, uses limited attention as the bound on rationality. And one of the things that's nice, I think, about thinking in that framework is it starts to help us think about heuristics and rules of thumb that people use to simplify difficult decision processes. And that sort of carries over nicely to the world of finance because it helps us and maybe link to things like the style-based investing of, say, Barbaros and Schleifer, for example. Gabay and Leibson and their co-authors model and then test in an experimental setting what they call directed cognition effects, which is sort of a cost-benefit analysis of how you decide to allocate attention. And I think that that's something that sort of carries over into the framework that we're thinking about here. And in organizational behavior, this framework is applied in a very simple setting. It's where, say, you have a manager that has to allocate limited effort across multiple projects. But there's also been limited attention both modeled directly and then analyzed directly empirically in financial economics. In asset pricing, Peng and Zhang have looked at this. And Peng and Zhang, for example, find that it leads to category learning that helps explain co-movements. Jay Kokenauer and I have a paper where we look at limited attention in the context of market making, where a specialist has to allocate attention across the stocks that they trade. David Hirschleifer and his co-authors look at how firms should disclose information when the audience that they're disclosing to has limited attention. They also have some more recent work where they look at how limited attention affects the reaction to earnings announcement. And testing this empirically, they show that the reaction to earnings announcements is muted in cases where the earnings announcement takes place on the same day as a lot of other earnings announcements that might distract investors. So I think that helps us start to think about what might draw attention or keep attention with a certain type of event. And Kaspersick, Neuberg, and Veldkamp also apply limited attention recently to fund managers, where they look at market timing and stock selection as two different tasks across which the fund manager might allocate their attention. So we have these sort of direct analyses of limited attention, but there's also all kinds of other literature in finance that looks at just the effects of attention, what draws attention. And I won't talk about all of these things, but let me point out a couple of things. Just in terms of what drives attention, Barber and Odin in their All That Glitters paper shows that retail investors, at least, tend to buy stocks that attract their attention because of news announcements or big return events, things like that. And other papers, for example, Tetlock, show that the market seems to overreact to stale news when that news has already been out there. There are lots of papers that looked at, for example, neglected firms and that there might be a return premium. Those aren't really directly related here. I think the paper here, though, is more directly related to the types of papers that suggest that because there's not enough attention, that prices don't fully incorporate information. And so there, I think it's more directly related to like the momentum paper of Dagaroon and Waraka, where they show that investors seem to react less to return information that comes out slowly than to return information that comes out all in big chunks. And then Cohen and Frazzini have a paper that also suggests that prices underreact to information that's available when investors have limited attention. So there's a lot of stuff out there on attention. I think the paper in its current form really is closer to the types of things here at the bottom and on this slide about underreaction and that we're not paying enough attention to information. But I think it could also say some more about limited attention and how attention is allocated with a few additional features. So to frame comments on that, let me kind of mention what I think an ideal test of limited attention would be. First, we would need to understand the set of securities or tasks across which attention is allocated. Then we'd need to measure how the attention is allocated or variation in attention across those securities. And then finally, we would need some clear test of how variation in attention would affect outcomes. Right? This paper really doesn't do much with the first point. The second point, sort of the implicit assumption here, is that attention is a decreasing function of time, or that we really don't pay attention to no news events and we pay more attention to news events. And then the paper focuses primarily on the last effect, where because of a lack of attention, the prices don't fully incorporate the available information about completion probabilities. So let me just make a couple comments along those lines. One of the reasons I think the attention setup here is a little bit difficult to pin down is because the mechanism isn't very clear. In some places in the paper, it seems as if we're talking about attention limits that would apply to merger arb traders. And in other places, it seems like we're really talking about attention limits that would apply to unsophisticated or maybe retail traders. And it makes a big difference because if you're talking about merger arb traders, you're talking about sophisticated traders where the attention limits would likely be small and they're focusing just on the set of mergers. If you're talking about retail traders, we're probably talking about bigger attention limits. They're looking at all stocks, and we know that their attention is grabbed by news and news types of events. So it makes a big difference in terms of the framework, the way we think about it. The other thing that I think is not fully incorporated here is understanding exactly how this mechanism works once we start with a big attention grabbing event. Right? This is a big, important event in the life of the firm. It attracts attention. If you think about the merger announcement, you could think about the merger arbitrators coming in and a bunch of retail traders coming in as well. It's not clear then what happens next. Right? So do the retail traders leave because a bunch of other stocks attract their attention? Right, so that mechanism is not very clear. If we could somehow measure attention more directly and separate the cases where the passage of time is the important factor versus cases where other types of things attract attention or draw attention away, I think we could have more powerful tests here. Another place where I think it's important to understand the passage of time is that the idea of the idea that the passage of time is likely a second or third order effect in many of these merger deals. If you think about a merger arbitrator trying to estimate the probability of completion or failure on a deal, they're using all kinds of information. Information on the status of the deal financing and shareholder approval and antitrust issues. And so there are some deals for which all of those other issues are probably the predominant sources of information about deal completion, and other issues where maybe there aren't as many of those types of things, and passage of time is a key determinant. And if we could separate those and focus on the ones where passage of time is likely a first order effect, again, I think we could get more powerful tests. And the authors do a couple of things where they start along those lines. One is they take the information from Mitchell and Polvino and they note that, look, deals that have really big arbitrage spreads tend to have a higher likelihood of failure. So for those types of deals, we don't expect the passage of time to have as much effect or as much information about the completion likelihood, and that's exactly what they find. Another example is they use a placebo test where they look at tender offers. And the idea there is that tender offers have a stated expiration date, so we don't expect the passage of time to have as much information there. And that's exactly what they find. But what I find interesting about the tender offer example in their study is that the hazard function for tender offers, if I understand it correctly, looks very similar to the hazard function for other types of deals. But there's not the return effect. And so it's not that the passage of time doesn't contain information about the likelihood of completion, it's that it's incorporated into prices properly. And so it's not clear to me why there would be differences in attention to information or no information for tender offers versus other types of deals. And what I think is more likely here is that tender offers are an example of the type of deal where other things are the dominant factors that would drive the estimation of completion probabilities, and passage of time might be more important for other types of deals. So the more that we could condition on those types of factors and separate those two things, I think the more powerful the tests. So the last thing I'll mention is that in the data filters that are applied, they talk about excluding deals that have explicit expiration dates or anticipated dates of completion. And the one thing that I would like is just a little bit more explanation. It makes sense that they're doing this. It makes sense that they say this. But what I'm confused about, though, is that my understanding is that most deals, or at least a lot of deals, have some sort of drop dead date in them where there's at least an estimate of how long the parties think the merger will take to complete. And so the merger traders or the other people in the market who are looking at this information are obviously going to use that to estimate likelihood of completion. So a little bit more explanation about what exactly they're excluding there I think would be useful. So overall, I really like the paper. I like the setting. I think if we can condition more to isolate the cases where passage of time is likely to be a key determinant of completion probability, that would help. And then understanding the attention mechanism here, I think would also be very helpful.